Now, I'm sure everyone would like to reach their goals faster, whether it be reaching your desired weight, getting a promotion at work, or just saving more money. When it comes to the world of investing, the goal is to accumulate wealth as quickly as possible, such that we become financially free and are able to retire earlier. So that's why in today's video, I wanted to share with you 5 actionable strategies that you can implement today that will help you retire faster. So the first strategy to help you retire faster is by reinvesting your dividends. Now, dividends are essentially profits that a company has made that it's then returning to its shareholders in the form of a dividend. Now, you could choose to either pocket the cash and just use that money as you would any other form of income, or you could reinvest that money back into the company and buy more shares. Whilst having a little bit of extra cash in your pocket might sound tempting, reinvesting your dividends can really pay off in the long term, especially in your journey to early retirement. So for most shares, ETFs, and index funds, when you first invest into them, you're given the option as to where you want your dividends to go. They can either be transferred directly into your brokerage account, or they can be reinvested back into the fund. My recommendation is to resist the temptation of having dividends deposited into your account, but instead have them reinvested into the company. Now, there are 2 key inherent benefits as to why you might want to choose to reinvest your dividends. The first one is that it's extremely cost effective. All brokerage platforms will allow its investors to reinvest their dividends at no additional cost. This can be an extremely cost-effective way to continue to build up your investment portfolio without being charged additional fees or brokerage costs. The second benefit is that you achieve greater compound growth. By reinvesting dividends, investors can take advantage of the power of compounding. And compound growth is essentially interest that you earn on your own interest, which will in turn produce greater investment returns over a longer period of time. For example, if you had invested $1,000 in 1993 into the MSCI World Index and then chosen not to reinvest your dividends, your $1,000 would have grown to $3,231 by 2018. However, if you had instead chosen to reinvest all of the dividends, the same $1,000 investment would have returned $6,416 instead. In percentage terms, it's the difference between your money growing by 323% without dividends reinvested, or 640% with dividends invested, nearly twice as much. The reason for this stark difference is essentially due to compound growth. Essentially, you earn returns on your own returns. And this can really snowball over time to produce far more than you might expect. The second way which we can ensure that our money is working towards early retirement is by not trying to time the market. Subconsciously, we all do this to a certain extent. We might think, well, the market is at an all-time high right now, so I'll wait until it falls a little bit lower before I invest. Or you might think the opposite, and the markets are down right now, but I think it's gonna fall even further due to all of the talks about recession, so I'll just wait and see before I invest any money. We all acknowledge that timing the market is a terrible idea, and that 9 times out of 10, it doesn't work in our favor. Yet we always think of a multitude of different reasons as to why it makes sense in our specific scenario. I know this personally because I struggle with these thoughts all the time. I've set up automatic transfers and investments, but just can't help myself when I see the market and think, maybe I should hold off from investing, or maybe I should invest sooner, either because the market's overvalued or undervalued currently. The biggest risk of market timing is actually not being in the market at critical times, because investors who try to time the market often miss periods of exceptional returns. This chart right here shows the hypothetical investment of $1,000 invested into the S&P 500 in between the decade 2009 through to 2018. If the $1,000 investment hadn't been touched through the full period, it would have grown to $2,775 with an average annual return of 10.75%. But missing just 30 of the best days in that period would have put the investor in the negative territory, losing 8.18% of the initial value. Of course, investors could also leave the market and miss some of the worst days. However, studies have generally shown that people tend to generally stop investing after an extended period of market downturn, and they only return to the market after it has already bounced back. Rather than try to predict the highs and lows, it's important to stay invested in in a full market cycle. Focus on the time you stay invested and not the timing of your actual investments. The third way that we can ensure that our money is working towards early retirement is by going down the route of lump sum investing over dollar cost averaging. So whenever we come into a windfall or a large sum of money, dollar cost averaging essentially refers to the act of spreading out that money and investing smaller amounts over a number of weeks, months, or perhaps even years, rather than just investing it all at once. Lump sum investing is essentially the opposite of that, and essentially where you take all of the money available and invest that directly into the market immediately and get that money working right away for you. Now, generally, I am a big fan of dollar cost averaging, specifically because of the psychological benefits that come along with it. First off, it can significantly reduce the emotional roller coaster that comes with investing. By consistently investing a fixed amount into the market, you can avoid getting caught up in all of the ups and downs of the market. This means that you're less likely to make impulsive decisions due to short-term market fluctuations, which can save you from significant stress and anxiety. And secondly, dollar cost averaging promotes discipline and consistency. By sticking to your investment plan and regularly contributing, you're developing a routine which will help you set you up for success later on in your investment journey. However, when we look at lump sum investing versus dollar cost averaging from a purely analytical perspective, lump sum investing actually beats out dollar cost averaging from a total investment return perspective. In Vanguard's 2020 research, they looked at the difference between dollar cost averaging and lump sum investing by assessing different stock to bond portfolio allocations across 3 different countries. They went through and modeled the returns between 1926 and 2011 and found that at the end of a 10-year period, lump sum investing strategy led to an overall higher portfolio value when compared to dollar cost averaging approximately 68% of the time. The study's recommendation was for investors to lump sum their money into the market to gain exposure to the market as quickly as possible. The fact of the matter is that the stock market will more often go up than it goes down. History has shown that the longer the period, the higher the chances of a positive return. We can see here the chances of the stock market going up or down over different time periods. Over a 1-year time frame, the stock market is going to go up 73% of the time, whilst over a 10-year period, the stock market will be up 94% of the time. The fourth way that we can ensure that our money is helping us reach early retirement is by avoiding analysis paralysis. This is akin to someone not investing or not investing enough simply due to being overwhelmed by all the different choices out there. Investing in general often sounds and feels complicated. We often think of complex Excel models, graphs and charts showing hundreds of numbers with really fancy people screaming and shouting at one another. But in reality, it isn't all that complicated, and it's only complicated because the financial industry is working hard to make you feel that way. What happens to many of us is that we get overwhelmed by all the different terms and investment options that are out there, and we never end up investing our money, which is extremely detrimental to our future selves. You're doing your future self a great disservice if you aren't investing now. And I promise you, 10 years down the line, you're never gonna regret that time when you invested your money because, in 10 years time, it would have grown to a significant amount. Even though I'm only 30 right now, I already have regrets as to why I didn't invest sooner. My first investment was when I was 25 years old, but I probably spent a good 1 to 2 years on the sidelines just researching everything about investing and what to invest in. Should I invest into stocks or ETFs and everything in between? Had I only have invested sooner, my portfolio would probably be significantly higher than what it is today. The last way that we can ensure that our money is working towards early retirement is by not chasing the shiny new object. And what I mean by that is to not invest into the latest hot stock that everyone is talking about, or the latest ETF or managed fund that has just delivered exceptional returns over the past year. Trying to chase performance is generally discouraged for a few key reasons. Firstly, stocks or funds that have had their stock price increase significantly could find that it's actually overvalued now, meaning that the stock price doesn't actually reflect the underlying fundamentals of the company itself. Secondly, whilst these stocks can continue to perform, they can also be exposed to sudden declines or increased volatility. Buying into a stock or fund purely because it has performed well in the past can expose you to greater risks that you might not want to take on. And lastly, chasing performance is typically due to FOMO. Everyone else is making money on that hot new stock, so why shouldn't you? However, if you're hearing about the stock on the 7 o'clock news, chances are the boat has already sailed. If we let our emotions cloud our judgment, it can lead to investment decisions that we might regret later on in life. I myself have actually fallen victim to this. Back when I first started investing, I invested into this micro investing platform known as Spaceship. Back then, this was one of the hot new micro investing platforms that everyone was talking about, simply due to the fact that it had produced phenomenal returns for several years straight. I ended up investing over $10,000 into that micro investing platform, and suffice to say, still to this date, I'm still down around $4,000 from its all-time high. Had I have just instead invested that money into an ETF, I probably would have made a return on my money instead of being down $4,000. So lesson learned from me that I'm hopefully passing on to you is not chase that shiny new object that everyone is hyping up. And that's all I had to share with you guys in today's video. Now, if you enjoyed the content, make sure to hit that like button down below, because it tells me that you guys enjoy this type of content so I can make more in the future. Now, before you click off of this video, if you guys are interested in learning about the world's simplest investment portfolio that you can invest into as an Australian, check out this video right here.